As a locum doctor, you've got your hands full with your practice. Managing your invoices, pension forms and expenses can make life a bit insane. Meet My Locum Manager. With My Locum Manager, managing your locum admin becomes simple. It automatically prepares and sends your invoices and pension forms, freeing up your time. With the integrated diary, you can add jobs in one easy step and access your schedule on the go. The at-a-glance reporting suite instantly shows you how much you are earning and any outstanding invoices. The Easy Session Tracker shows you how many sessions you work on average, so you can accurately calculate your indemnity costs. The Expense Tracker helps you stay on top of your business expenses, and you can send your tax reports to your accountant at the touch of a button. And this user-friendly platform is optimized for your mobile phone or tablet, so you can work whenever and from wherever you please. Start saving time today. Sign up for a free trial.
So, hi everyone, my name is Serena. I'm a GP based in London and I'm co-founder of My Locum Manager. I've got Matt here, he's my tech support today. Do you want to?
Hi.
There's his hand, and we've got Hannah here as well. So we've got loads of people, all the numbers clocking up. So we're just going to give a couple of minutes for everyone to log on before we kick off this webinar. So you guys can, we want this webinar, as all of ours are, to be really interactive. So you can post questions in the questions box. So maybe just have a go and tell me if you can hear us okay, first of all, if you can see everything okay, and also maybe let me know where you're listening in from, so who you are and where you're listening in from, and that will give me a chance to check out that everything's working and also let us settle in while everyone's signing up. So here we go. Yeah, still coming in. Oh, great. Thanks, Jamie. And thanks, Catherine. Can hear us loud and clear. Hi, Ken. Thanks for joining us. Great. Thank you. And where are you all based? Just type in your location so I can see. Are you all London based? Are you up north? Are you in the Midlands? So lots of people. Oh, Southeast London. I grew up there. Kent. Oh, lovely. St Albans, Northeast. Great. Manchester. Hello. Oh, amazing. Cambridge. Cardiff. Oh, hello. And Natalia, you're from Liverpool. Oh, hello. Wow, we've got a real kind of UK-based audience today. Great. So I think we've still got more people signing up, but and logging in, but shall we get started, Hannah? So just to give you a brief overview, as I said, so I'm a locum GP. Matt and I set up My Locum Manager a few years ago now, and it's grown from strength to strength. So if you're a locum and you're using it, thank you, and keep sharing it. And if you haven't used it yet, do check it out and give it a try. So Hannah and I are doing this webinar today because we did a really popular one last month, which was all about creating wealth through tax. And many of you couldn't get on. We did have to close the list because it was fully booked and oversubscribed. But also we got lots of feedback from people saying we'd really like to cover a few basics again. So things like, for example, setting up as a sole trader or limited company, like making that decision. Some of you were saying it'd be really helpful to know about mortgages for locums, because some of you have just finished your training and you've been on, had a pay slip and had a salary as an employee. And now that you're going into locum work and you're thinking, I might want to buy a house, what does that mean for what I could borrow to buy it? So we're going to cover that. Expenses was another big one. What expenses can you claim? IR35 is another huge one. So we've kind of created this miniature version of the webinar today to really cover through those key facts, and then we're planning another one on investing and what to do with your money as a GP, because no one really ever tells us how to kind of create wealth through what you're earning. So we're going to do that at a later date. Great. So let's get started. So, oh, yeah, so a bit about us. So that's me and Matt, and this is my locum manager. And as I said, we set it up because as GPs, we kind of felt like we needed something to help us manage our money and just manage us as self-employed people and help with CPD and learning and things like that, and just really help us with our independent little businesses that we have as locums. And so, and that led to my locum manager, and it's grown from strength to strength. So Hannah, would you like to introduce yourself?
Yeah, absolutely. So hi everyone, my name's Hannah. So now you can see my face, but for the sake of the fluent connection or internet, we will close off the video in a bit. Hi everyone, I am a tax accountant for GPs and for
Oh, we lost you there,
Hannah. My company is called Xceptional Consultancy. I've been running it for since. Oh, okay. From where? From which bit?
Should we turn off the videos?
Yeah.
Do you want to do yours?
Oh, how do I do it?
Yeah.
So Hannah, I'm just going to turn off the video so that everyone can hear you a bit better. Sure. I think your connection's a little bit thingy.
If Hannah does her own one, I think.
Oh, Hannah, you're going to have to turn off yours.
Yeah.
What have I? Oh, I haven't turned it off.
Okay. So I think now can you hear me better now?
Yeah, much better.
Okay, great. So let's keep on it. So yes, my name's Hannah. I'm a tax accountant for GPs and for other doctors. I'm a founder of Xceptional Consultancy, which is a tax consultancy firm and accountancy firm for doctors. I'm also the public speaker, and recently I published a book called Discover Wealth Through Tax. And when I'm not crunching numbers, I'm a black belt in Taekwondo. So that's just a little bit about me. And yeah, shall we crack on the main content?
Yeah.
Yeah. Okay. So we planned out, and of course we'll cover some basics, the things like the universal rules of tax that just over the last couple of years, I discovered my way of explaining tax, some basics, so you have the logic to apply to into any situations. I will today talk about the key deadlines. For this part of this bit, I will also cover things like sole trader versus a limited company, and also the key deadlines for sole trader versus limited company, and then how each entity you draw money differently from your business. And also IR35 is very popular topic. So in particular, a lot of you have passed the anniversary of the IR35. So especially if you're doing the work that are inside IR35, I will talk about some expenses claims in that. And also, we will cover advanced strategies for using the cash in the company. And lately, we'll cover things like when you get a mortgage as a locum, you're self-employed, what you need to look out for. And also, we'll briefly talk about tax-efficient investment. But for the sake of the webinar today, because this will be a very huge topic itself, so I just cover like briefly, but then we'll cover that in the future webinar. Okay, and then we'll summarize and wrap up and for the Q&A. Okay, so I think that's that's become limited company and sole trader. Of course, yeah, I think one of these is a universal rules of tax, but then we'll cover this first. So sole trader and the limited company, I think is still one of the very, very huge topic. So it's important to identify that as a sole trader, you are your business, everything you earn, or the profit you earn from the business, doing your locum work, and then it's taxed under you. But the company, it's a separate entity from yourself. So it's a separate thing. It has a separate set of responsibilities. So you and your company, you are the taxpayer, and also the company is a taxpayer itself. The benefit of running a company, of course, for pure tax consideration, especially if you're earning like over 50K or even 100K a year, it is likely that you save tax by using the company. But in particular for GP locums, one of the downside that you need to look out for is you will lose the NHS pension. It's not like completely losing it, but you will not be able to contribute to NHS pension when you use a company to do your locum work. That is one of the reasons why a lot of people, they stay as a sole trader for the sake of keep contributing to their NHS pension. So of course there are pros and cons. A very typical pro for the sole trader is the responsibility is much less, but for the company, because you are the taxpayer yourself and you have to take care of the company. So it's basically two sets of tax return you need to submit, and the company itself, or the financials will be published like publicly in the company's house. So that's the other thing to be aware of, that your company financial situation will become searchable in the public. And of course, like it's a lot more admin to do. So yeah, but then that's for a lot of people, for the sake of tax efficiency, maybe the amount of tax saving has outweighed all these admin expenses. So that's one of the reasons why people go for a limited company. Okay, so let's get to the next slide.
So Hannah, quick question about this. So a couple of common things that come up with people trying to decide between a sole trader and limited company is, when should they think about setting up a limited company? When does that forgoing the pension become worthwhile for them?
Okay, that's a very good question. So of course it depends on the individual. For instance, it's really, I think for the GPs, either they do exclusively locum work, or they might have something which is NHS job or salary job, and then have something else, do like both self-employed and employed. So if you're exclusively doing locum work, I would say the kind of I call this sweet spot. It's not for everyone, but it's sort of average sweet spot. That is around 50K on the profit. So that is when you're hitting the 40% tax bracket. That was a time that it becomes more beneficial, because company tax you only pay 19%, but then if everything is under you, you start paying 40% plus all the national insurance and everything. So that's a kind of sweet spot. But most likely for the ones who are doing PAYE job, especially the ones doing NHS work, which is salaried, they still have the pension. But anything on top of that, which are self-employed, which are locum work, outside IR35, or people doing private work, they will use a company structure to protect it.
So if a locum, or if a sessional GP is earning more than 50K, you're saying then it's probably worthwhile then thinking about becoming a limited company?
Yeah, but be aware that 50K is on after expenses. So I would say for the average for the GP, if their claimable expenses is around 5K, 5 to 10K, I would say, then that's like 55 to 60K. That's a gross income level. But
the other thing is, if you're a sole trader, because your pension is essentially you get tax relief on your pension. So is it So if you're earning 50k, then maybe another 15k of that would have been your pension contributions for that year, or 10k would have been your pension contribution. So actually, with a sole trader, you're probably earning a bit more, and then your pension contribution is taken off, and then you pay tax on what your income is. Am I making sense?
Yeah, so for the sole trader, I think for the locum rate, because when you're self-employed, you pay like employer's contribution and employee's contribution on your pensionable earnings. So a lot of rates, they were like, maybe it's like say 75 £75 per hour. That's all inclusive. But then, the 50k is after all the expenses and the pension contribution. So when it comes to your question, like maybe for some people, maybe it becomes better off because of the tax relief on pension. Well, in some cases, yes, you get tax relief on the pension contribution, and you sort of contribute to it. It's pre-tax. Again, it still depends on the level of your earnings, especially when you're earning 100k, like over 100k. That's probably like the pension contribution as opposed to limited company. Limited company still can help save a lot of tax. So for some people, yes, but depends on your earning level.
Okay, so I guess the take-home point is, if you're trying to decide between whether you're going to be a sole trader or a limited company, you need to work out, are you going to be at that 50k higher tax bracket? And if you are, then I guess could it be an option where you're a sole trader up to about, say, 40 something k, and then you also have a limited company? Can you do that, or?
Well, yes. So if you're a sole trader doing some locum work, and then you want to put something else that is into the company, that is fine. Yes, there's no problem of doing that. Although a lot of people who are doing that, the company work is mostly like a private work or something else, something that is like distinguishable.
Okay, all right.
Yeah.
Good, thank you. If there's any other questions about like trying to decide between a limited company or sole trader, just post them on, and we'll make sure we deal with those. Yeah,
absolutely. But of course, if it's always case by case review. So if any further questions, be free to post. So something about getting the benefits out of a limited company. One of the things is maximizing tax deductions, which we'll cover in the next one of the next slides. Taking money from the company in tax efficient ways. Yes, salary versus dividends. And today we're also going to look out for some other ways apart from salary and dividends. There are some more advanced strategies, and also, of course, considering your long-term vision. For some people, they might just want to try out locum for like 3 months, and afterwards they don't want it anymore. So although for the financial side, maybe you save tax on this locum work by having a company, but there will be costs involved when opening and closing it down. So if doing locum and being self-employed is not part of your long-term vision, then I would say that's not really worth it. Okay. So yeah.
So Anna, just before, because we're getting loads of questions about the limited company sole trader. So I'm wondering, shall we deal with that now and then move on to the next bit?
Okay. Yeah.
Okay, so one of the questions we've got is so didn't understand, so that's from Vinu. Didn't understand sole trader up to 40k, then limited company above. What happens to the NHS pension? So I meant by that, so say you're earning up to 50k as a GP, so maybe you're doing salaried and you're locuming, etc. So you're pensioning that income up to about 40k or 50k. then
Mhm.
to stop you going over that 50k bracket, can you set up an additional limited company so all your other locum work or portfolio work or you know, kind of private work, whatever it might be, goes through the limited company, so that your self-employed income is just going up to no more than 50k, so therefore you're not going over that tax bracket, and any other income is going through a limited company. So that's what I meant, Vinithan. So I hope that clarifies it. Have you got anything to add to that, Hannah?
So, well, by law or by, like, you know, for the tax point of view, there is nothing wrong of, you know, you want to cut off like level of income and then going to the next, you know, set up a company for anything over. Although I haven't seen people doing, you know, doing like NHS work until 50k and still doing NHS work and using the company. I haven't, like, practically haven't seen people doing that. But what people has been doing is, you know, they might ask how much NHS work they can do, and then because a lot of people, they want to gradually move to private work or doing something else for the company.
Yeah.
So one of the most popular questions actually people asked was like, how much NHS work I can do to still pay into the pension and don't pay too much tax. And then for the company side, they can do whatever they want. So that's a practical, like, what practically people has been doing, and what people tend to ask me.
Okay, and Naomi Pereira, hi Naomi, you're saying, will you cover locum form A or B? It's all confusing. Yes, it is, but my locum manager takes care of all that for you. So if you haven't signed up to it, sign up to it and check it out. But also you can email Matt, he's put his email on there, and we've got a YouTube video that explains it all, so we'll send you a link for that. But yes, it's confusing, but that's essentially why we made the site, so it would simplify all that for you. Okay, so another question from Chasku. Hi, Chaksu. Hi, Chaksu is asking about private pensions in limited companies, and is saying, how do we set up a private pension if we choose to become a limited company?
Okay, so in terms of the private pension, of course, on one thing, depends on the type of pension. If you just want to pay, like, you know, normal private pension contribution out of your take-home pay, then you can do you can sort of you know, contribute to whatever supplier you want. But always you need to make sure when you go to, like, decide which pension provider to go for, and always seek for a financial advisor for this kind of advice. For the company, I understand there's also like company pension. So it's like company acting as your employer, and it's like every time you take a PAYE salary, and then you will contribute on your behalf. So that can be done as well. That can be done as part of your, you know, you take a cut on your pay and then contribute directly to the pension. That can be set up. Again, you can go through the same process, like seeking for financial advice to look out for which pension provider to go for, to make sure it's more specific for you. But on the practical side, you know, when you work with accountants, and the accountant doing the PAYE payslip for you, and they will take into account. And every time you do pay yourself, and your limited company will contribute the cut for you. So hope that answered the question.
Yeah, and then Manaza Ahmed, hi Manaza, is asking, when you use a limited company, yes, you save the tax, but the company bank account gets rich and grows. However, you're restricted to taking out 50k. How do you take money out effectively? Because as soon as you do, you start falling to the higher tax band. So Manaza, we're covering this in this webinar shortly. And then we've got another, so stay tuned, because we are covering that in a few slides down. And Aisha, hi Aisha, you're a familiar name for me on the webinars. I see you coming up quite a lot, so welcome back. So Aisha's asking, can one set up a limited company with one person?
Okay, so from what I understand is, does that mean can you set up a company with someone else together? Was that what you
I think
mean?
that's what she means, yeah. Aisha, if that's not what you mean, then just message back and clarify. So I think she means, can you set it up with someone else?
Yes, yes, absolutely. So you can set up, I think very commonly like husband and wife thing, especially both are working as a locum or doing a similar type of work. So what they do is both are directors in the company and they split the company shares. So either like 50-50, or maybe sometimes one of the spouse is some family, one of the spouse maybe is have very little earning or maybe not working at all. So, but then they also want that spouse to get involved doing some admin or making some small decisions. So they get a relatively less percentage of the shares, or maybe they are the secretary of the company. So yes, you can take two or more than two people as long as it's a business strategic decision. Yeah.
Okay, and then Jamie, hi Jamie, is asking, what about a limited company through Jersey? Is that more tax efficient and is it feasible?
Oh, okay. So that is a very interesting area. Jersey, well, to be honest with you, at the moment we don't really touch like Jersey or any offshore this kind of advice. But then if you do seek for like Jersey or offshore, then I am able to see point you to the direction that see who can help you.
Okay, and then Chaksu's asking, roughly what are the costs in becoming a limited company? How do you go about doing this? And where's the best place to read about this? So I think in terms of how you would go about it, you would find, say, someone like Hannah or a good accountant to talk you through. But cost-wise, Hannah, roughly cost of setting up or a limited company?
Okay, so I think for the cost depends on how you see it. If we say, just register to the company's house, registration fee is only, I think it was like between 10 to 15 pounds to the company, to company's house. But if you use like agency, go online, some online provider, and they do all the paperwork for you, there are some yeah, it depends on different agency, but they charge differently, like 50 pounds or 60 pounds, depends. For accountants, for me, yes, I do help setting up the company, but because I know some people, they say they could have just to do the setup all themselves. So what I normally do is, because we want to set it up, also need to make sure you are aware of what you're doing, you get all the guidance. So that's why I normally have an upfront fee, including advice if someone want to come to me to do the setup. Yes.
Okay, and then Jenica, hi Jenica, is asking, what if you're a partner but then you're doing locums as a sole trader? What does that mean for your about your tax? And Jenica, do you mean if you're a partner and you're doing locums, should you do it as a sole trader or limited company? Is that what you mean? Or do you mean, what about your tax? Because I guess your tax would be, if you're working as a partner, because you're paying your pension twice really, aren't you? You're paying your employer and then your employee pension, and then when you're working as a locum as a sole trader, you're paying just your employee pension. So Jenica, if you just clarify that, then we can answer that question for you. Next questions are, oh my goodness, so many other ones. So I think the next ones, okay, so Aisha's asking, I'm a sole trader, my husband is a higher rate PAYE, can I set up a limited company with only one director?
Yes, yes, only one director. That is absolutely okay. Yeah, a lot of locum GPs, they do set up as a one director and the only shareholder of the company. Yeah, the sole owner of the company.
Yeah. And okay, so Jinika's just replied. So she's a partner and she's doing some locums as a sole trader. Like, what's the most tax efficient way for her if she's doing both?
Okay, so I think it really depends on the other side of the work. Of course, one side you need to consider the pension, but if we were to like look into the tax efficiency, so you are the partner, you already contribute to the pension and you already do the self-assessment, which is like, you know, the profit share from the partnership, that is through your self-assessment, and you already pay income tax on that. If you do the additional work as a sole trader, of course, this work, this income will be adding up on your existing income. That will essentially bump up your income as well as the tax. But one possibility is if there's no other restriction, the other consideration is your other work you run as a limited company, and then that part of the income will be protected. You can just leave all the cash in the company, or you want to say every year you have 2,000 pounds tax-free dividends, which you can do that, or you need some other ways to extract, and that's fine. But for the sake of tax efficiency, having a company for other work is more tax efficient. But again, there might be some other restrictions of the other type of work. So need to make sure there's absolutely no other restrictions of you setting up a company for your other work.
Okay. Okay, we'll come back to the other questions as we go through because they're going to be relevant for the other slides that you do. So I'll let you carry on with your slides for now.
Okay, yeah, sure. Okay. Okay, so the next slide.
Yeah. Oh, sorry. There you go.
Okay, I think that's a record keeping part. Perhaps that's Serena, you will talk more about.
Yeah. So we've had like lots of questions about how can I simplify kind of my kind of, you know, income, my pension and my, you know, my admin and processing. Well, that's actually essentially a lot of what my locum manager does. It's very user friendly. You can take pictures of your receipts and they'll be uploaded onto your site. I use it for my locum work. And kind of it's designed to be like one click and it will do all your pensions and it will do your tax and your expenses and things like that and help you track. Like there you can see it will track how many sessions you're working on average, who hasn't paid you yet. So it's perfect for whether or not you're a limited company or sole trader. But also it means it's much easier for you to track all your tax deductible expenses. And we did a survey last year and actually it turned out that a large proportion of locums weren't claiming most of the tax deductible benefits that they were supposed to, and a lot of this was coming down to time, just, you know, the practicalities of trying to do it. And the fact that you can save My Locum Manager as a web app on your phone means that it's pretty much there. So I tend to, like, if I get into, I don't know, a taxi to go from one place to another, I'll just, you know, take a picture of the taxi receipt and just upload it there and then. You can do it all in real time, which makes it much easier. But the other reason why people weren't claiming everything that they needed to was because often we didn't know the things that we should be claiming for and you know what we should be recording in order to be tax efficient. And you often hear like so many different things as to the kind of things you should be keeping a record of and the kind of things that you should be recording. So to make it simple for you, if you're a member of My Locum Manager, on the resources section you can download this expense performer, which covers all the different types of expenses that you can claim as a GP whether you're a limited company or a sole trader. It covers things like, if you're buying a car, for example, on hire purchase, it will cover if you're changing your vehicle, household expenses, professional expenses, and also other expenses as well. So you can download that from the site. But I think, Hannah, you're going to talk us through a couple of expenses that are quite easy wins for us as GPs, and that may make a difference on our income.
Yeah, that's fine. So I think perhaps they are like for expenses claims, they are black and white ones. The ones are very straightforward. But also there are gray area ones. So some of them you might need some justification. Depends on how you justify. So of course we covered things like use of home, how you can claim the portion of your home expenses when you do some work from home, and also things like car hire purchase, or how you can claim things like mileage, all these things. Some other common questions, like people ask me, can you claim clothes? So it is a very interesting question, because some people say they buy the suit just for work. But for HMRC point of view, that suit you can also wear not just for work, but can be other occasions, like maybe in a wedding, maybe in some other personal occasions. So if there's some personal element of it, you cannot claim it. But in terms of clothing, if you have a special uniform, a special clothing that you only wear for work, then that is fine. But also the other thing, maybe it's not very common, but for the clothing, even if that's normal clothes, not necessarily say the uniform type, normal clothes, but as long as you have your business logo on it, then that is a marketing expense. So that's just like one little trick. And of course, like for in practically, it's not be for everyone, but if that's for you, and that you can easily justify that. Some other things, I think that's also a little bit, I would say a little bit gray, especially you have family members. You hire your family member, like your 18-year-old, to help you to do some admin. So if you go for like family Christmas party every year, so and then you hold it like open to all your employees, which are your family members, as long as you keep it under £150 per head, then that's a tax deductible expense, because that's like annual function or annual party for the employees. So that is tax deductible expense. It just keep them motivated, keep them engaged in the work. So these are some justifiable area, but of course there'll be a lot. So if you do think of anything or you're not sure, you can post on the chat.
Yeah, no, that sounds good. And with regards to what about, like, so if you're locuming, and one thing I realized was kind of, your printer cartridges, like when you're printing out your pension forms, or you're I don't know, printing out lists, work related things in your mobile phone, broadband, using your room as an office. Can you just clarify what the safe way of doing that is? Because I think there was an issue with capital gain for a certain level of claim.
Yeah, absolutely. I think if that's related to capital gain, especially when you are about to sell your home, that need to be careful. So when it comes to like claiming part of the home expenses, say if you have a room that you use for the office, and you use that broadband, you use additional utility, you can claim a proportion of that. So you might want to decide, maybe you work like 20 hours a week from home. You decide what a percentage of that or maybe you want to decide what's the space, of that particular room in your home that you use as office. So that's like a for space side, which is maybe related to the capital. But things like printing cartridge or even upgrading the internet broadband to the business, these are expensive sides. So I don't see these are, especially when printing cartridges or the stationery, mostly we just expense as an expense. So that's not going to be affecting the capital gain. But when you decide like claiming part of mortgage interest, when you're a homeowner, you need to be careful. So just a little bit on the capital gains tax. If you make a gain that is under 11,700, you don't pay capital gain. That's the current tax rate. So even if you do have a small percentage that is you're claiming the mortgage interest, perhaps in the end it's the capital gain, the taxable gain is under that 11,700, then you'll be fine. Yes, so again, that will also depend on the valuation of your home, like when the time you want to sell or the time you buy. So what's a possible profit of that? Yeah, so that's just a brief idea on like how you can safely do it.
What about,
yeah.
Sorry, Anna, one question we've got through is, so this is from Samir. Hi, Samir. This is, the question is, can I claim tax on mileage? And what about claiming tax on my car lease payments?
Okay, so from what I understand is the expenses, yeah. Okay, so for the car, I think that can be a very big topic, but just some brief idea. So if you have your personal car and you drive for work, and then one way you can claim mileage, which is you collecting the business miles. So the first 45p, the first 10,000 mile is 45p per mile, and afterwards is 25p. So that's a flat rate claim that will cover like your petrol, your repair, your car, any car cost. So you cannot claim both. You cannot claim petrol as well as a mileage at the same time. So you need to decide one of them. But if you don't want to use that flat rate claim, then you just collect all the expenses, but then you claim a proportion of that. So you need to decide what's the percentage of you use for work, like 40% or 60%. So these are two ways, but you need to decide which way you want to use. So it's really depends on whichever is more beneficial for you.
So it's asking, what about claiming tax on my car lease payments?
Okay, so that is yeah, because car lease payment, that is more related to like capital.
Yeah.
Yeah, so of course if you whether lease car or like whatever, you can, if you decide to use a mileage claim, then you can. But if that's like personal car, I would say still stick to this one of these two if that's a personal car. But if you use a company, say the company to lease a car or to buy the car, that will be a different story. So depends on like whether you are buying the car or leasing the car yourself, or you use a company to do it. But if you do use a company, there will be capital allowance for the company tax. So
Okay.
that's yeah. So I hope that answers the question, but that can be getting into a lot of details.
Yeah, so Francesca's asking, before we move on, can you claim your travel to and from work or just the actual home visit?
Okay, that's again another gray area. So I think that bit I will cover in more detail in the IR35 bit.
Yeah.
But the general rule is when you travel, for instance, when you travel from home to work, you argue that your home is you work from home, your home is your permanent office, and whichever practice you're locuming with, these are your clients, which are temporary place. So if that's a temporary nature, then you can claim travel. But if you have been there, like you've been commuting over and over again and for over to the same place from home to that place for over 2 years, then the taxman will perceive that's more of a permanent place for work. So yes, if that's become like a more of a permanent nature, then you cannot.
Yeah.
So yeah.
So in terms of your mileage, so when you're putting your jobs onto My Locum Manager, it will automatically calculate and store that, and you can also add your home visit mileage to it. So your accountant can always run through that when they're doing their tax return for you, but at least it's all been calculated. Okay,
Yes.
so we've got loads of questions coming in, so we'll definitely answer as many as we can towards the end, but I'm conscious that, Hannah, you've got quite a lot to get through, and
Yeah.
we're already like more than halfway through, so
Yeah. Yeah. Okay. So just some key deadlines. As we mentioned, for the sole trader, you have less to worry about. Um, a lot of you guys doing the self-assessment, which is 31st of January, the following year. So that's just every year one of responsibility. Well, paper filing, if you do online, it's 31st of January, but paper filing is 31st of October, which is a couple months earlier. But I don't see many people doing paper filing nowadays because online is just very, very easy and a lot safer. In terms of self-assessment, say you started locuming in April 2018, there was this, well, HMRC have a kind of a soft deadline. It's like you need to register self-assessment by October 2018, so beginning of October 2018. But that's a very soft deadline. So yes, that's like you need to register self-assessment. But then even if you, in reality, even if you do register a little bit later, it's not a big deal. But that's just a very soft deadline. So if you have been like started locuming somewhere from April 2018, so if you haven't registered, make sure you do register as soon as possible. I think it's about the time, just end of September and beginning of October. And for the tax and NI, one thing a lot of people maybe can find a bit surprising is for sole trader, they are having the second payment on account. Well, which is it's really literally a rule. It's not something that's logical. It's just a rule saying if like majority of your income that are self-assessed. So because a lot of you, if you are doing the salary job, your tax is being deducted before you get paid. But when you're self-employed, sole trader, you get paid first and expense it, and then at the end of the year, you pay tax when you do the self-assessment. So if you are doing that way, the HMRC will want you to pay half of next year's tax in advance, and then by 31st of January, and then by 31st of July, you pay another half. So basically, it's just an advance payment rule. That's something you need to be careful, especially when you are first started being a sole trader and started to make a profit. So that's something you need to be aware. I would always suggest like about 25% of your gross income to save for the tax and national insurance. If that works for you. Of course, 25% is not say you definitely have to put aside 25%. Everyone have different situation, but that's just a general guideline. You do need to set aside some percentage of the income for the tax when you're sole trader. Yeah, I hope that's if there are any questions. Yeah.
So do you think, so 25% whether you're a sole trader or limited company, or does it differ?
I would say this would be sole trader, because this company will, although you will still like make sure you have save some money for the tax, but a company will do it differently. Yeah, so I would say it's for sole trader.
Yeah, and just to be aware then, after your first year, you'll then be paying tax in January and I think it's June, isn't it?
Yeah, end of July.
July. So you'll have two payments to make. Okay, great. So let's move on to the next.
Okay, so for the company will be a little bit more complicated. So company, I would say there are four. Well, essentially there are a couple of things need to be aware. First of all, there's something called confirmation statement. That sounds like quite a bit of jargon, but that's just every year when you reach your company anniversary, that just say you need to pay £13 to company's house to keep your company registered and also confirm all the detail is correct. So it's a very simple, quick piece of work, but then that's very important. And that's 14 days after your company anniversary. So normally company's house will send you reminder on these things. Or if you already work with accountant, then the accountant should be able to take care of this for you. We also have company's accounts, which is a financial statement of your company that need to be submitted to company's house, and then they put it publicly. But they are not going to put every single details in the public. They will essentially they will put what's the valuation of the company in the public. That just say if you are say you want to apply for a loan from the lender, and they might search for this information, so they will understand what numbers to search for. So these are the things that are searchable in the public. That need to be filed 9 years of the financial year end. So yes, the financial year end depends on which month your company is set up. If you set up in somewhere in January, then your year end is 31st of January. And then you will have 9 months time to submit your accounts. For the corporation tax, just need to clarify. Most of the time we do accounts and corporation tax the same time, because the payment deadline is the same time, but the filing deadline for corporation tax, there will be extra 3 months. So, but most of the cases, just to make it simple, we just keep everything 9 months. So 14 days and 9 months, these are the key deadline that you need to be aware of. Yeah, I hope that's clear. But if you do have any questions raised anytime, feel free to let me know. Okay, so we are going to talk a bit about IR35. I think one of the things like inside or outside, of course, on the like guideline, there are so many details, or there are so many articles talking about this, like control, like your financial risk, or like substitute. Say if you cannot carry on the work, can you find someone to substitute you, things like that. But I would say one of the things to determine inside or outside, your intention is very important, or maybe your like your preferred way of working is very important. For some people, they want more of a stability. They want to go to work and get paid and as stable as possible. They don't mind being controlled. They don't mind being told what need to be done and how to do it. So that's absolutely fine. But that way of working is more of an employer and employee relationship. So if your working relationship with a practice, with or with the end client is more like that way, and if you're doing like a locum work, that falls into higher risk of inside IR35. So again, this is not completely black and white. It's more of a high risk or low risk. So it's really somewhere you are somewhere in between. But if you are more of some people want flexibility. They want to have a bit of variety of working with different practices, or maybe they are a bit of entrepreneurial. They want to be seen as a service provider to their clients. They don't want to be told how to do things. They have their own way of doing things, or they are highly specialized in something, and no one is able to tell them exactly what to do. They are here to provide expertise and to add value to the client. So in that case, that's more of a supplier and the client relationship. So if you are working more of that way, then it's more likely that you are more of outside IR35. And of course, other things like if you cannot do the work yourself, or if you are not available for certain sessions, you can just turn off, say no, I'm not available for that. So you have a say on that, as opposed to employer-employee relationship. You cannot say no on these things. You absolutely have to do it. Doesn't matter how much you don't like it. And also you might need to give certain notice if you are taking on leave or taking on holidays if you are an employee for someone. But if you are the supplier and they have no control, very little control over these things, you might just mutually agree a deadline or a certain way of doing things, but they don't have this control over you.
So
Okay.
I think the locums, just to summarize, so essentially on My Locum Manager, there's a set of terms and conditions that you can use, which highlight that, are you, for example, so when I'm working at practices, even if I work there and I know those practices, I set the times and dates. So they'll say, can we have a locum for today, maybe the morning? And I'll say, yes, these are the hours I can do. Do they work for you? And then I'll bring my own equipment. And if I couldn't turn up, I could text some locums I know to cover for me. So I guess in that sense, then I'm quite protected from IR35. If, however, you're working through an agency, or I know some practices are just doing blanket IR35,
yeah.
Then and your pay will be deducted at source. But I just don't tend to work in places like that. I just pick and choose where I work. So
yes.
There are some areas, I know in Scotland that's been raised a few times as well, where practices are just saying it doesn't matter, we're treating everyone as IR35 and they're deducting your pay at source, in which case if they're deducting your pay at source, Hannah, does that mean they're essentially like an employee, or can they still claim the same expenses that they would claim as a locum?
Okay, so like if they blank out you as inside IR35, technically,
yeah, but say you're
yeah.
you're a locum GP, I work at a practice and they've said no, you fall within IR35. Can I still claim my normal expenses for that job, even though I've been taxed at source?
Okay, so that's actually lead to the next slide.
Okay, will I go to the
We're
next
gonna
slide?
talk.
We're
Yeah.
running a bit over now, so we'll have to blitz.
Yeah.
blitz
Okay,
through.
so but this has been very, very popular, like how you claim expenses. Because when you're locum and they say inside IR35, chances are they still pay into your company, but it's a tax deducted. Okay, so the way I see this, because the IR35, inside IR35 work, you are technically an employee. So all this income you declare through self-assessment, and you just say they give you payslip or P60 or whatever. You just declare what's your gross pay and what's the tax deducted. But I think most of you are familiar with when you're PAYE, you claim these BMA, GMC courses, claim the tax rebate on this. So you do the same on your self-assessment. So basically on your self-assessment, for instance, you earned 30K this year, which is gross, which is inside IR35. So you put that into your self-assessment. You declare how much tax being deducted, but you put through your expenses like BMA, GMC, these expenses through that, just as if you are claiming tax rebate as an employee. But on the other side, the limited company. So here we really need to see company and yourself, you are separate. So company is still up and running. The company still maybe paying for the software to keep all the records. The company is still paying for accountant or any professionals to look after the accounts, or maybe have some other expenses, or perhaps for some people they still have other work which are outside IR35, which is going in the company. So you claim the expenses like business related expenses as euro for the company. It's just the IR35 income. It's technically an employment income, and you claim your BMA, GMC, these expenses as if you are employed. So it's very important now you see yourself and the company as separate. So hope that helps.
If I'm as a sole trader, if I normally claim all my expenses, but I've worked at a practice where they've said no, they just say no, anyone who works at our practice falls within IR35. So I get paid, but they've deducted my pay at source. Can I still claim expenses? Like, can I still claim my mileage for that job? Can I still claim my equipment or whatever else I would claim as I normally would?
Okay, so if you are a sole trader, again, this will see like yourself and your sole trader business. If you still claim, see yourself still running a sole trader business at the same time, or intend to do some other work at the same time. So again, you will take out like the IR35 income that's become technically an employment income, and you do the same thing as what's on the left-hand side. But the right-hand side, you have a self-employment section on your tax return. You put whatever business, genuine business income. For instance, if you're doing other work like outside IR35, or maybe you don't earn anything at all, but your intention is still want to keep the business running, and then you still put through the professional fee, like you use accountant to keep all your records, you still keep your software running, your other stuff running, you keep in the sole trader business section. So yes, you do see yourself, the IR35 income and the business as a separate. But here, essentially, your intention is that you are not closing down the business. You want to keep the business running. So that's a key point.
Okay. So regards IR35, if you want a bit more of a breakdown on it, you can go get on the My Local Manager Survival Guide, which is on the resources section of the website. There's a whole section on IR35, and I also did an article for Pulse on it, so you can find that as well. But that will really break down into really simple steps about kind of how to protect yourself, what to do if you fall in it, how to keep out of it, and things like that. Great. Okay, so moving on.
Okay, so we're going to talk about taking money from the company. Of course, like salary and dividends is still a very popular way. It's most common and most safe way. And also, essentially, what people are doing is taking relatively lower salary, which just cover the tax-free allowance, and then take the other side as a dividend, because it's still cheaper to take dividends, and dividend doesn't attract national insurance. So that's like most common way. And of course, perhaps we do have a like proper case study, something. Perhaps we just briefly run through on this. But then if you do need like case study or anything, do contact one of us. But then essentially for limited company, most common way now is low salary and high dividends. Yeah, but today we're going to talk about some other strategies. Perhaps shall we move on to the next one? If you do have anything on the basic, you can let me know. Okay, some other things you can do. One side is a company pension contribution. It's like you can set up a company pension scheme, and then every time you do run a payslip for you, and the company contribute a percentage on your behalf. So that can be a very good way to save for the retirement. But at the same time, the pension contribution is deductible through the company. So you can use that as a strategy for your retirement. At the same time, you save some tax for the short term. If you do have family member who is able to work for you, especially like a younger, like 16-year-old, something like that, and they are not yet earning, and then you want them to get good work experience, they can do some work for you, like some business administration, some bookkeeping, and you pay them a small, relatively lower salary. So you can pay them just under the tax-free threshold. That is a tax deduction, but at the same time, they don't trigger tax for them. So that's a good way. And again, like early on, the annual dinner, when you have employee in the company, or this entertainment, there's the staff welfare, you can justify a lot easier than you are on your own. There's another thing, which is when your company has built up quite a bit of cash. Some of you have mentioned, if you do build up quite a bit of cash, and then whenever you draw out as salary or dividends, it will trigger tax. Yes. So if that's the case, and you don't need that cash for the short term, one thing you can do is setting up an investment account for the limited company, because the cash sitting in the company, if that's just cash, over time it will decrease in value. But if you do set up an investment account for the limited company, it will help you, like the money can grow and you can get a good return from it. And it's properly, if that's like properly managed, and then over time, it's not going to decrease value, or maybe give you a better return over time. So that's one of the advanced strategies. But again, that's your company need to have build up quite a bit of cash, and you don't need for the short term. And also for this area, because it refers to investment, a good financial advisor should be able to help you to manage the investment or see if that's work for you. But that can be a strategy for the companies that has built up the cash. It's like corporate investment. You have built the cash and you don't really need for the short term. So that can be a good strategy for utilizing the cash and without, eventually like decreasing value. Essentially, that's your hard-earned money. So you want to make it work for you. Yeah. So yeah, if you do have any questions about this, be free to post as well.
Yes, about taking more money out essentially of your company.
Taking more money out. What was
Yes,
the?
I was just saying, so if you want to maximize the amount you can take out of your limited company without how would you do it?
Okay, so if you do want to take out and without triggering a lot of more tax, and
Yeah.
of course on the next slide we'll talk a little bit about like director's loan strategy.
Should I
Um,
pop that one
yeah,
on? Oh,
yeah,
that's not.
yeah. So I think that happens, especially when someone has a big purchase, they need to take a director's loan suddenly from the company, and then it's repayable within 9 months after the immediate financial year end. So it's a loan. That means you need to repay it back. Otherwise, it's gonna get 25% additional tax charge. And of course, if you eventually pay it off, you do get you can claim this tax charge back. But that's sort of a cash flow aid strategy. If you do need a big purchase, and then over time you pay it off either by physically paying it back, or you offset with a further dividend or salary. So that's one of strategies. But if your company, say your company, you have land in for some companies or businesses, the director putting like at the beginning putting some money in the company to keep it running as a director's loan, and then they can use it. They can take out more as a repayment of their director's loan and without triggering any tax. So it's this is more of a lending, like you borrow money and company borrow you money. This kind of activity. So, but then that can be a like strategy if you do need some like cash, actual cash for a big purchase. But essentially, the following up planning, that's also very important. So when it comes to getting a mortgage for locums, I think for the tax side or for what accountant can do for you, it's not there's not nothing fancy. Um, but then what lenders normally looking for is they will consider both your personal income as well as your business income. So some people, they might worry that if they set up a company and they might need to take more dividends to show the lender that they have this amount of personal income. But the lenders will look at your financial accounts for the company as well. So they will consider everything. They'll consider both your personal income as well as your business income. Very common documents that lenders are looking for, your tax documents. I know this is nothing fancy, but very common thing. Financial accounts for last 3 years. For some cases, if you don't have last 3 years, it can be fine. This SA302, yeah.
Sorry to interrupt. I was going to say about this last 3 years. So when I was looking to buy my house, that was 18 months ago, it depended on the lender. So because I'd had like 2 maternity gaps as well, some lenders were just like, oh no, you need full 3 years of accounts. But there were some lenders who deal with locums quite a lot. So Scottish Widows were one, Clydesdale was another. There were a few others. So I think if you're looking for a mortgage and you're locuming and you're finding some lenders are saying, no, you need a certain number of years or you need a certain number of documents, do try finding other lenders as well, because I think there is a lot of flexibility, and different companies who work with locums a lot will understand what your income is and what your, kind of what you can borrow.
Yes, that's absolutely true. Because some of my clients, they actually using some companies that are specifically for self-employed or for these business owners. Because when you're self-employed, it become a little bit more complicated when it comes to like looking for this lending. But they are lenders that are specifically for locum or for self-employed. Okay, so normally they will need this piece of paper is called SA302. It's essentially something you need to request from HMRC. That's a tax calculation. So they will see some like with HMRC logo on it. That need to request from HMRC. Tax year overview. So if you do submit your tax return online, or your accountant has your like an agent acting on your behalf as agents, it's downloadable online. Of course, business financial accounts, mortgage reference, again, depends on the lenders. Some of them, maybe they just want to fill in the form. Some of them, maybe they want an accountant to write a good reference for them. So again, it depends. But then these are the things that very commonly when I deal with the locums, what they are asking for are these documents. Again, like things like SA302, or maybe sometimes when you reach a year end and you suddenly need accounts. So it's always good to like plan a little bit further ahead, because these things can take a time to produce. Like SA302 maybe take 2 or 3 weeks to arrive, and then you need something urgently. So it's nothing fancy, but good to like keep that in mind. Building up savings for deposits, it might not be, well, for some of you maybe want to build some savings for your deposit in various ways. Just say like ISA, because especially for first-time buyers, ISA is a tax-free environment for you to build up savings. So they are help to buy ISA or lifetime ISA. These are the type of ISA which are designed for first-time buyers, because the government do give you a certain amount of bonus when you if your buying activity meets certain conditions. Like help to buy, government will give up to like £3,000 as a bonus, so it's a very good return. And then if you buy the property, say if you buy property in London, as long as the value is up to 450k, then that's fine. And you can that's per ISA per taxpayer. If you buy with your partner, then that can double. So these are like a little bit things. Okay, yeah, I think we're good to move on. Yeah. Tax efficient investment briefing. So we just touch a little bit. There are certain type of investment that you pay the money into it, and then the government give you a percentage of the amount of investment back. So these are specifically suitable for high net worth individuals. Like if you are annual income is like 100k, and if you have quite a bit of cash, and also you want to find ways to mitigate tax quite significantly, or maybe you are the buy-to-let landlord, and because of the tax rate change, you're selling the property and you want to mitigate the capital gains tax. And one of the investment is very helpful, because it can not just give you the amount of cash back, but also it can help to defer the capital gain. But just a sort of a surface, on the surface, these are the things, these are the government schemes that to encourage the high net worth individuals to invest in UK small and innovative businesses. Because the government wants innovation, the government wants more people to have better ideas to boost the economy, to make other people's life better. So that is why government gives so generous tax relief for this type of investment. And yes, investors get a percentage of the amount invested. So for one of the scheme, if you invest £10,000 into that scheme, you get £3,000 back from the government. So that's that's the sort of tax relief you are looking at. But it can be very high risk, because it's investing in small companies, especially early stage startups. It can fail. So when the company fail, when busted, you might lose your money. So that's high risk. But as always, seek for independent financial advice to see if that's the kind of investment for you. Because chances are, if you are more of a conservative investor, this might not be for you because these are way too high risk. So yes, be careful on these things. So let's go to the next slide just to explain what are they. So at the moment, we have venture capital trust. So this probably is the lowest risk among these three because it's a trust fund. It's not an individual company. So the trust fund can be they invest in 10 companies, maybe 5 will fail, 2 will break even, and 3 will succeed. So it essentially spread out the risks. But the incentive is that the government give you 30% of the investment back as a tax relief. So that can be the good way because it's a low risk among these three, and at the same time it gives you good tax relief. That would be suitable, of course, high net worth individuals who has a bit of cash, which they don't really need for the short term, and or for the like buy to let landlords who also has a bit of cash that don't really need for the short term and want to mitigate this tax change. So that can be very tax efficient. But of course, this I only brief it today. In the future webinar, we will give a proper case study and also the calculated risk for you.
Yeah.
Yeah.
We'll go what kind of
time.
Yeah. Right. So let's blitz through the Q&A. We've got about 5 minutes to get through as many as possible, Hannah. So
okay. Yeah, sure.
So yeah, we hope that was helpful. So essentially, just to summarize, the key learning points from today, I guess, are when deciding whether you want to be a sole trader or limited company, obviously speak to your accountant, but look at what your income is. And I guess if you're going to be a higher rate taxpayer, there may be ways. So for example, if you're a partner and you're doing additional locum work, or if you're a locum and you're doing it as a sole trader because you're pensioning, there may be ways, for example, you set up a separate limited company, or if you're a limited company, there may be ways in which you can be more tax efficient in the way you set up your company and the way you draw your earnings. The other thing was about expenses. So I'm going to blitz through the main learning points and then go through the questions. So the other thing was about expenses. So have a system that keeps your expenses in real time and keep photos of your receipts and things like that, and know what you can claim for. And then the other bits, Hannah, were about kind of drawing money from a limited company and tax efficient ways of doing that. IR5, you can go on the My Locum Manager Resources section and get the survival guide, which covers that in a lot more detail. And then regards investments, we're going to be covering that in a much more detailed webinar about what to do with your money and how to maximize. So very quickly, let's blitz through. We've got some really good question that's come through. Just trying to find where I was. Agneska is saying, hi Agneska, can you clarify regarding clothes for work which are not a uniform but they're elegant and used only for work? Can she claim for elegant clothes? Which she said, can I claim it as a sole trader, Locum GP, as a marketing expense? I like where you're going with that, Agneska. I mean, I'm quite imaginative with what I can do, but that is very, that's a good one. So can you claim, the question is, Hannah, can you claim elegant clothes which are for work as a marketing expense?
Okay, so I think this depends on how elegant it is. And I think this definitely it's a great area. When you say like elegant clothes for work, depends on what your intention is. So because I know if in the business world, someone want to stand out as a personal brand, and they need a certain type of clothing which is suitable, bring out more of their personal brands, then that's more of a branding side. So when it comes to elegant clothes for marketing expense, um, on the surface, the most safe that would be if you are able to have your business logo somewhere on the clothes, which become removable, but doing it nicely, then that's definitely a marketing expense. But it just bring out my experience on the proper business world, because we want to stand out as a personal brand, and we want to like use a certain clothing to bring out more of a personal brand, and then to for the certain way. So if you are able to justify it as a branding in some way, then that will be okay. But I wouldn't say that's a marketing. That's more of a branding, or it can be, well, it can be marketing, but
So
I would say that's more branding.
yes or no? Can you do it or not?
That's very gray area. Okay, so under the condition that you have the business plan, or you have some wording that it's necessary for your business to brand you that way, and that is claimable. But you need to have some documents in place that is in black and white say that that branding thing is necessary for business.
Okay, so I guess if you want to risk it, you can do it.
Yeah.
It's what the grey area
Yeah,
means.
yeah, very gray. Yeah.
Okay, but I think, to be fair, that is a fair point, because there are some clothes that I just wear for work, which I wouldn't really wear out, or I would just wear, they're my work clothes. So I guess that there is an argument that actually, I don't know, that we could claim.
Yeah, it's not written anywhere in the rule. But if I was to use a judgment, then it's just like a speaker. They need a certain clothes to represent themselves on the stage, and they wouldn't wear off the stage. So it's just something
There
like
are
that.
times where I would happily do a locum shift in my pajamas, but obviously I don't do that. So therefore, I think some nice, elegant work clothes, which I would just wear for work, surely should be tax deductible. But I guess, Agnieszka, I think the thing is, I guess you could try, you could buy the clothes, keep the receipts, and claim them, and see what happens.
So put
Okay.
a note on the receipt that it's a necessary for you as a brand.
Yeah, that's a good idea. Okay, so Sommer's asking, can we claim for any purchases like computer, mobile phone, or tablet, and is there a limit to it?
Okay, so the answer is yes, especially if you have a company and you put on the company's name. So make sure on the invoice is on the company name, and then no, there's no limit on it as long as you can handle it.
And what about if you're a sole trader?
Sole trader, yes. So if you have a like tablet just necessarily for your work, yes, that's absolutely fine. Of course, maybe you have the sole trader name is just your name, but then you might want to put on the receipt just say that's for business. Yeah.
Okay, and then next question is, Matt, can you just make these questions a bit bigger, because there's so many of them, it's really hard to see. It's really hard to see what the, oh yeah, perfect, thanks. That's my tech support there. Okay, right, so I'm going to try and get through these really, really quickly. So Nabufe's asking, hi Nabufe, please, she's saying she's trying to do a tax return. So she's a salary GP, also doing out of hours work, which is now taxed at source due to the new IR35 rules. How can I still claim my expenses since both incomes are now taxed at source before I even get it?
Okay, so what I understood is you want to still claim all these BMA like expenses, even if you are now
mileage, BMA, or equipment costs for out of hours work.
Okay, so in that case, of course, things like a professional fee, your equipment, these are definitely necessarily for you to carry on the work. These are okay. But one thing I would say, be careful on the travel expenses, because when you're inside IR35, chances are, unless it's home visit, like from workplace to workplace, temporary nature. But then most chances are, if you are inside IR35, when you go to work, it's a normal commute. Yeah.
Okay, great. And she's saying, what about phone use? Can she claim those on her tax return?
Okay, so you mean like a phone, you are the work inside IR35?
Yeah.
Okay, so if that's the case, phone use need to, again, it's similar to travel. You need to be really careful. You need to make sure that what's a percentage that is genuinely for work use, necessary for work, and what's a percentage that you use just for personal. So you need to make sure whatever you claim, it's absolutely necessary for work, and you cannot do your work without.
Okay. And Rue's asking, some practices are insisting on IR35, even if the locum doesn't have a limited company. What disadvantage is this? And I guess we've covered that in terms of, well, it's disadvantageous because the expenses you would claim if you weren't taxed at source as an employee are much more broader. You can claim a lot more expenses, and I guess it's more tax efficient. But if you're being taxed at source, you're basically being taxed like an employee. So there's no way of being more tax efficient with that. Is there anything else you would add to that, Hannah?
Okay, so what's the disadvantage for that? I think the advantage or disadvantage is very, very relative. So like, of course, for tax, it's less tax efficient. But what if you like you're more of a stability driven, you just want to go to work and get paid, don't have to worry about anything. Then if you are that, then yes, maybe that's more for you.
Okay. And then Naomi saying, I'm doing 6 sessions salaried and 2 sessions as a locum. How do I sort out my pension and tax? Naomi, that's where something like My Locum Manager will really just sort it out for you, because it will track all of your locum income, pension and expenses, and all you do is you give that to your accountant along with your is it your P40? What is your for your salaried at the end of what is it? The P60. So you'd give your P60 and your downloaded sheet from My Locum Manager to your accountant, and then they'll sort out the rest for you. Okay, next few questions are there's some really good ones on here. I love how you guys are like really imaginative with your with their where their things. So Agnieszka said thank you. She will try out the grey area because she likes the adrenaline. Let me know how that goes, because I might copy you and do. Jinika saying if you're switching from it, so she's the partner who's also doing locum work, and if she's switching from a sole trader to a limited company, can you do that halfway through the tax year?
Yes, you can. So you can set up a company whenever, in whatever point. Yes, you can.
Okay, so Vinuthan is saying, what about courses abroad? Can we claim flights and accommodation? Do you see? They're just
very creative. Okay, so
I'm getting so many ideas for my next holiday. I mean, my next CPD session.
Well, CPD, if that's genuine CPD related to your work and you related your locum work and it's continuous education, yes, absolutely, including your flights, your accommodation, your food over there. But make sure the course is necessary for you to do the work for your business.
Everyone now after this webinar is going to go and look up a holiday. I mean, not a holiday.
Yeah, making your holiday tax deductible.
And can you tax deduct your children's travel as well? Because saying that they're going to take your notes for you, even though one of them can't read or write. Can you do that? I don't know.
Okay, so if you're gonna do that, make sure your children actually do the notes for you.
All right, I got like what, a couple of months to get him to read and write. Okay,
Yeah.
I can do that. So thanks for that question, Vinithan. I think you've made a lot of us GPs very happy. I think part of it works so hard, but you just get so little perks for the job. So if there's anything
Yes.
claim to make your life a bit easier, everyone just jumps on it.
Yeah,
Last
yeah.
time, for those that didn't come to our last webinar we covered childcare, tax credits and things like that, which was really, really useful. Jinika saying thank you. She's got loads of questions. Well, you're welcome, Jinika. I hope you try out My Locum Manager, and you can email us any questions that you have on here. Okay, last question before we wrap up. This is from Soma. Hi, Soma. For a high tax-paying salary GP, is it better to be self-employed or a limited company if the locum income is about 30 grand?
Okay, so is that you were asking you already have a salary or you have some other income already reaching the high rate and you do the 30 grand locum work on the side?
Yeah.
Okay, so in that case, yes, for pure tax consideration, yes, if you do set up a company for that 30 grand income, that essentially help you to protect your personal income, because that's like company income is separate from you unless you withdraw it and adding up to your own income. But if that's sole trader, everything added up on you. So for the pure tax consideration, yes, being in the company saves tax. Yeah.
So if Soma sets up a limited company for the locum work,
Yeah.
then she'll be paying how much tax compared to, because if she's combining the two, she'll be paying kind of over the odds as a sole trader. So I'm just trying to think, what roughly will the saving be?
Okay, so
Ballpark.
yes, so if everything added up, that 30 grand, well, we just say 30 grand is a net income after the expenses. If that's sole trader, everything added up, then that will be taxed on 40% if that's a sole trader. But if that's a company, that's only 19%.
Yeah, so that's yeah. Great. Okay, cool. So what would be really helpful, Vinuthan's off to book somewhere to Hawaii. I am joining you in Hawaii. My CPD, Vinuthan. If you have any other questions or if you have any ideas for future webinars that will be really helpful, like maybe you want us to do a whole webinar on IR35 or you want, any particular learning things, then just post them on the questions or email us. Do share, Hannah's there to help you. So if you're looking for an accountant or you know anyone is, then, message them about Hannah. And if you're a locum GP or locum GPs, feel free to share My Locum Manager so we can keep doing loads of these webinars and keep doing loads of fun things for you, like getting you free CPD in Hawaii. So we hope you've enjoyed yourselves. There's our contact emails if you need it. I don't know if there's anything else you want to say, Hannah, before we sign out.
I think that's covered a lot of things. And of course, thank you everyone for attending, especially. It's a lot of things to get through, and thank you so much for engaging till the end.
Your hilarious creative questions.
Thanks for all the questions. I think I can write another book on all the creative tax deductions now.
There you go. Yeah. All right. Okay. Good night, everyone.
Yeah. Good night. Thank you very much.
Bye.